everyone, welcome back to the show. Thanks for tuning in. Happy Friday. Hopefully everyone's got a good weekend planned. Today's going to be a great segment because we're going to be talking about how to buy spreads for less than intrinsic value. So if you're familiar with Trades Live from the research team, where you might see a few of the research traders talking about this, or if you subscribe to the Cherry Bomb, which is an email in the morning where either TP or Tom writes an email, and they usually talk about when they're looking at long spreads in that email, they usually talk about buying it for less than intrinsic value. So actually today I'm going to talk about how we actually conduct that and how we set that up. But if you aren't getting the Cherry Bomb and you want to, you can just go to your account tab at the top of in. You can go to your profile page and you should be able to click a button to subscribe to that email listing. But today we're gonna talk about that intrinsic value and really just figure out how to buy things for less than intrinsic value, which number one gives us a positive theta effect, which just means it is going to gain value and be good for us over time if the stock price doesn't move and if implied volatility doesn't move. And when we're setting that up, there is going to be more benefits than not when we're getting that certain aspect of that right. So when we're buying a spread for less than intrinsic value, we're going to have a much better situation than if we're buying a spread for over intrinsic value. So let's talk about intrinsic value real quick, and we'll go on to the next slide and we'll break down what we're looking at with calls and puts and how this really relates to expiration and the owner of these options. So really when we're looking at intrinsic value, we have to realize that only in the money options have intrinsic value. So if you ever hear the term in the money, that doesn't necessarily mean that it's profitable or not. In the money really refers to an option having real value at expiration, and that real value is known as intrinsic value. So a call has the right to buy shares. So the call owner has the right to buy shares at a certain strike price. So that would mean that in the money calls would be below the current stock price. So if I've got a stock price trading at 50 here, any call below the 50 mark, so if I have a 49 or 48 or a 40 call as we see here, all of those calls, anything below the stock price would be considered in the money because they will have intrinsic value at expiration. Now we know that as expiration comes about, like today at 3 o'clock, there's not going to be a lot of extrinsic value in these options. Any options that you see that are in the money are going to be trading pretty close to just the difference between the stock price and that strike price. So if I have an example here where the stock is trading at 50 and I'm long a call at 40, this call has 10 points of intrinsic value. So what that means is this call is going to be trading for right around $1,000 near the close today, because again, every call option or any option in general has the theoretical equivalent to 100 shares of stock. So if I'm 10 points in the money with calls which would be below the stock price, that's going to equate to about $1,000 at expiration. Now what's really important to note is that when we're a buyer of this option, of course that's great if we have calls that are in the money, but if we're a seller of this option, especially if we sold it for less than $1,000, that's where we're going to see a loss. So it's important to realize that in the money doesn't always mean that it's profitable. In the money really just talks about and refers to the intrinsic value of an option. So if we look at the other side of the coin, puts, which really give us the right to sell shares at a certain strike price, that's going to be the opposite. So anything above the stock price would be in the money for puts. Now if we think about the actual implication of both of these options, it makes total sense. So for calls, I have the right to buy shares at 40 even though the stock price is trading at 50. So of course that option is going to have real value because it gives the trader a real discount to purchase those shares at 40 even though the option is, or the call in the stock price is trading at 50 there. And for here, if I have the right to sell shares, if I'm the put owner, if I can sell shares at 82 when the stock price is trading at 70, that's going to give me a benefit and that's going to give me real value at expiration because I can either sell this option for the intrinsic value of 12 points here or $1,200, or I can just exercise the option. So if I already own the shares, let's say I owned the shares at 82 and I wanted to buy a protective put. It's not something that we normally do, but it is a traditional option strategy where people would buy shares and then buy a protective put as full insurance on those shares. So let's say we bought shares at 82. The stock price is now at 70. What I can do is exercise that put and basically get rid of my shares at the price of 82 as opposed to taking that loss at the 70 stock price where it's trading now. So both of these options have intrinsic value, and this is why they have intrinsic value. But really what we're focusing on is how to purchase spreads for less than intrinsic value, which give us some benefits. So let's first walk through a long call spread on the next slide, and we'll walk through an example on how we get to that intrinsic value and calculate what we need to buy it for to get less than intrinsic value. So let's say I've got a long vertical call spread, which just means I've got a long call that's in the money and a short call that's out of the money, and we're dealing with the same expiration. So let's say we had a stock price trading at 75, and I decided to purchase a call at 70 and sell a call at 79. So usually we're looking to pretty much straddle the stock price, but in this situation, maybe there wasn't enough premium to give me that less than intrinsic value premium, so I had to move my strike a little bit closer. Normally we'd look to just make it completely equidistant, where I've got a 70 call, and if the stock price is trading at 75, I would maybe look to sell an 80 call. But because of maybe a volatility skew or just the extrinsic value of these options, I had to slide it down just a bit. So there's a few things we need to calculate first. Well, what is my total value? Well, number one, let's say I can sell, or I can buy this strategy for $4.80. Okay, well, I can do that, but I don't really know if that's good or bad until I calculate the intrinsic value. So let's do that really quick. So I know that when it comes to intrinsic value, as I just said, intrinsic value is only in the money options. So this option has no intrinsic value. So what I need to focus on is my in the money option that I purchased. So I know that to calculate intrinsic value, all I have to do is calculate the difference between the stock price and the strike price of the in the money option. So if my stock price is at 75, and my call that I purchased is at 70, that gives me 5 points of intrinsic value. So that's going to be $500 at expiration. At expiration, this spread's going to be worth $500 if the stock price does not move at all and implied volatility doesn't change at all, even though implied volatility really has to do with extrinsic value. So at expiration, that's not really going to matter anyways. So let's pretend that I purchased this long call at 70 for $6.50. So I can quickly know that since it has 5 points of intrinsic value, there's $1.50 of extrinsic value here. So it's just the difference between the $6.50, I subtract that intrinsic value of $5, and I get that extra $1.50. So what do I know about that $1.50? Well, if I want to buy this spread for less than intrinsic value, I need to collect more than $1.50 to make that happen. So let's say I can sell this call at 79 for $1.70, and that brings me to a debit of $4.80. If I'm buying a call for $6.50, selling a call for $1.70, that brings me to $4.80 debit. So what's going to happen at expiration? Well, this is a successful strategy where we put this and we set this up with, we're basically long this spread for less than intrinsic value. So since I'm only paying $4.80, and I know that if the stock price stays right here, at expiration, this spread will actually gain value. That's where you get that positive theta effect. So theta really talks about the decay of an option's price. So normally from a premium seller standpoint, if I sell an option here and theta refers to the option decay over time, that's going to be beneficial for us because it's going to allow us to potentially buy back that option for a lower price. But really what we want to think about is theta being good for us. So if we can create a situation where we have a positive theta effect or a beneficial theta effect when we're actually long a spread, then that's going to be great. So over time, this spread will actually gain value if the stock price stays right here. And that's because we know that the call is going to be worth $5 at expiration, and basically the entire spread will be worth $5, but more likely than not, this option right here will be worthless since it's out of the money if the stock price stays right here. So effectively, I would have purchased the spread for $4.80, and at expiration, I know because of the intrinsic value of the long call that this spread will be worth $5 if everything stays right here. So this is how we set it up to give ourselves that beneficial theta effect where our spread actually increases over time even if the stock price doesn't move. Now of course, if the stock price goes up, that's going to be great for us because this long option will gain even more value. And that's what we want to do when we're long a call vertical spread anyways. It's a bullish strategy. And of course, we're going to lose money if the stock price goes down. So if the stock price goes below 70, by expiration, we would have lost that full $4.80 debit that we paid, but we can't lose more than that since that that is our cap. Since this is defined risk and we're dealing with the same expiration cycle, there's nothing more that we can lose in this trade right now. But let's go on to discuss a long put vertical spread, and we'll really calculate the different side of things. So let's say I have a different underlying that I want to get long a bearish spread in, and we're going to do just that. So let's say that stock is trading at 50 and I'm looking to put on a long vertical put spread. So I would do the exact same thing. I would purchase an in the money put and sell an out of the money put against it to reduce my cost basis. So really I'd be looking at a put that's in the money, which would be a put above the stock price. So let's say I chose the most liquid strike, which was the 54 strike. And I look to sell an equidistant out of the money put. So this one is perfectly symmetrical. I've got 4 points here to the downside and then another 4 points where I'm selling the put to give myself an 8-point wide long put spread. So I know I've got 4 points of intrinsic value here, which is just the difference between my strike at 54 and where the stock price is trading at 50. And let's say that put was worth $5. So I've got $4 of intrinsic value, $1 of extrinsic value, which means when I'm selling that put, I know I've got to sell it for more than $1 to cover that extrinsic value and bring that total cost down to below intrinsic value. So I've got that $1 in mind, and I find a put at the 46 strike that's trading for $1.10. So now I can become long this spread for $3.90 of debit. So I know again at expiration my spread's going to be trading for intrinsic value at expiration if nothing changes here. So I know that 4 points of intrinsic value lies in this long put. So at expiration, my spread will be worth $4. So again, we have the same scenario where I've purchased a spread for less than intrinsic value because I collected more on my short option than the extrinsic value of my long option. So in these scenarios, we've been lucky where we're able to set up a good scenario here. It's pretty rare where we can set it up completely equidistant and collect more on the out of the money put side than we're paying on this in the money put in terms of extrinsic value. But there are a few ways that you can skew this. So we know that an extrinsic value curve will look something like this, where extrinsic value is highest with at the money options, and it'll start to taper off as you go far out of the money, and it'll also start to taper off as you go far in the money. So what are some ways that we can skew this strategy and skew this spread to put ourselves in this good position at all times? Well, the first thing we can do is move our in the money option further in the money. So for the put side, that would mean we would move it a little bit further up, which would make it trade more for almost pure intrinsic value. And when we're looking at selling an out of the money option, we can move it closer to the stock price, which would give us more value. So basically the more we move our put in the money and the closer we move our short option, the easier it will be to trade this for less than intrinsic value. But sometimes we can get this perfect scenario where we have here, where we're completely equidistant and volatility is being good to us, where we can actually buy this option that's in the money and sell an equidistant out of the money option for less than intrinsic value. And on the call side, it would just be the reverse. So if I had that call that was in the money and long here, and the call that was short and out of the money there, I could move my long call deeper in the money and move my short call closer to the stock price to get that less than intrinsic value a lot easier. So let's wrap all this together with some takeaways for you. The very first takeaway we've got is that we want to get that positive theta effect. We don't always have to be at the mercy of negative theta with long options. So if we are very careful about how we set this up and we are very aware of the extrinsic value in that long option, we can make sure that we sell our short option for more than that to get that positive theta effect and buy the spread for less than intrinsic. And with poor man's covered calls and poor man's covered puts, which are actually diagonal spreads but very similar setups, we don't have to get that less than intrinsic value on the first short option we sell. Because if I'm buying an option in August and maybe I'm selling an option in June, I do realize that if the trade doesn't go my way, I can just close that June option or let it expire out of the money and sell another July option. So if I can get pretty close to covering the extrinsic value in my long option by selling the one in my short option, that's going to be fine, because if my trade doesn't go my way, like I said, I can just sell the other option in the next cycle and it would bring me down to less than intrinsic value overall. And of course, these little tips go a long way. So there's a big difference between buying a spread for more than intrinsic value and having time decay work against us, rather than getting ourselves in a position like this where we can actually benefit from time decay and still be long a spread like this. So thanks so much for tuning in. I hope this helped out. Next time you look at the cherry bomb, hopefully you'll understand when they're talking about buying something for less than intrinsic value, this is exactly what they're talking about. If you've got any questions or feedback, shoot me an email here, or you can follow me at DoTraderMike on Twitter. Stay tuned though, we've got Jim Schultz coming up next, and have a great weekend. Hey everyone, thanks for watching our video.
If you liked this video, give it a thumbs up or share it with a friend.
Click below to watch more videos, subscribe to our channel, or go to our website.